Every day, the world moves on as it always has. Cities wake up, work begins, and life feels familiar. But beneath that sense of normality, something is shifting. The climate is changing, and the systems we rely on, energy, food, water, cities, finance, are under pressure in ways we're only beginning to understand. These changes don't live in reports or projections, they are already shaping people, livelihoods, and communities. We created the Climate Leadership Podcast so these challenges don't remain abstract or distant, but are explored through the people working inside these systems, making real decisions with real consequences, often without clear answers. This is not a space for fear, blame, or perfection. It's a space for honest conversations about what leadership looks like in a changing world. If you're listening, you're already part of that leadership. Let's begin the conversation.
Welcome to another episode of the Climate Leadership Podcast, where we explore the real systems and decisions shaping global energy and climate outcomes. Today's episode focuses on a crisis that is no longer theoretical. Disruptions in the Strait of Hormuz are already impacting global oil flows, tightening markets, and driving volatility across economies. I am joined today by Mr. Claudio Galimberti, Chief Economist at Tristed Energy. With over 2 decades of experience, Claudio shares how geopolitical shocks translate into real market dynamics and economic consequences. Thank you, Claudio, for joining us today in this conversation.
Thank you so
And
much.
before we begin, I would request you to share a bit about your professional journey so far.
Sure, absolutely. So I am the chief economist, as you pointed out, Amber. I joined Reister about 5 years ago. I joined after, let's say, 2 decades in the industry. So I was at Shell for many years in a variety of roles, primarily on the trading side of things. I was also in another trading organization, Trafigura, and I was at S&P for about 3 years before coming in. So in total, I have accumulated so far 25 years since I graduated from college as an economist at Bocconi University in Milan. So I'm originally from Italy, as you can guess, and I've been in the United States for almost 25 years at this point. So I just spent a brief period of time at the very beginning of my career when I was working at Shell, and then I came to Houston, the capital of energy, the capital of oil, and I never left.
Okay. Thank you, Claudio, for joining us today. And to start a conversation, how would you characterize the scale of disruption we are currently seeing through the Strait of Hormuz?
It is the largest disruption I have seen in my 25 years, but even if I was to go back and look at other crises, for instance, the 70s, which is what everybody is comparing this crisis to, it is bigger. What we need to consider here is every time you analyze the energy market, you probably do it when you go to lectures. You look at the mass balance, right? So the supply and the demand, and of course the supply back in the 70s was much less than what it is right now. The supply of energy, supply of oil, etc., because the demand was much smaller. The economy was much smaller back then. Therefore, we take a relative measure. So what is the size of the disruption? How many barrels of productions are offline in comparison to demand? And how do the current demand, and how do they compare to the history? So right now we have more than 10% of the oil supply being offline. And it's been offline for more than a month. And this is the result of the Strait of Hormuz being shut. Back in the 70s, the oil embargo crisis of 74 kept something like 6% of oil supply offline. And the Iranian revolution in 1979, it was 4%.
Okay.
Now, there is a huge difference. So in terms of the total supply that we are talking about that's been impacted, this is the largest crisis we have seen since World War II. The difference so far is the duration. We've only been in this crisis for about 2 months, right, at this point. While when we talk about the crisis of the 70s, they lasted for years. So we are not at those levels yet
Okay.
in terms of
Okay.
duration. Yeah.
I see. All right. So you have suggested that markets may still be underpricing risk. How do you see that disconnect playing out in the current environment?
The answer to this question may take a few minutes, so it's not just going to be a soundbite. There is this common concept in amongst economists, amongst analysts, and amongst people in academia that the market tends to be efficient. Right? So it incorporates all the information immediately, efficiently, and there are some distortions that they quickly smart money figures them out. Right? So if the market is underpricing the risk or underestimating the risk, then somebody should take an opposite position and profiting from them until the market rebalances to a situation of equilibrium that reflects reality. Now, since the start of the war, what we notice is that there was this growing, um, basically every day you would see more and more production coming offline. First it started in Iraq, then you had Kuwait, then you have, until you reach something like 10, 12 million barrels a day of supply of oil being offline. I don't, for the time being, talk about LNG just to keep the analysis relatively simple. So with this, we need to ask ourselves, okay, so what are the alternatives to a situation in which you keep on losing 10 to 12 million barrels a day of production every day, which is 10%. So the alternatives are very little. So there is the only thing you can do in a situation like this is to reestablish the flow in the Strait of Hormuz, which in a span of 2 or 3 months will bring about a normalization of the production. But then, if you analyze the geopolitical kind of confrontation between basically the war between Iran on one side and Israel and the United States on the other side, there are no particular reason to be optimistic that this will be solved very soon. So then the follow-up question is, okay, so if we keep on losing, if Hormuz is not normalized, and we keep on losing 10 million barrels per day of production, how quickly are we running dry on the tanks, on the inventories? And the answer there is complicated by the fact that there is not full visibility across the world. But we are relatively certain that there are some products and some sectors that will face basically a supply shortage quite soon. Something like the aviation sector in Asia can face some systematic shortage already in the month of May, towards the end of May, beginning of June. So that's the reason why I said the market may be underpricing the risk, because if there are no alternatives and we are going, it's a slow motion kind of train wreck against towards a supply shortage, prices should be much higher, right? Prices should be much higher. So the way we rationalize this is to say that the market so far strongly believes that there will be, before long, in the next 2 to 3 months, 2 to 3 weeks, a structural solution to the Strait of Hormuz. If that is the case, so if somehow you get to a point where you start to normalize the flows in the Strait of Hormuz, then yes, then you can barely dodge the bullet, right? Yeah. So, but should prices be higher at this point? I argue that prices should be higher at this point. So the market is to some extent flying with too much optimism.
Yes, I was thinking market is behaving, too much optimistically.
Yep. Yes.
Okay.
So it happened in the past, right? So you have periods, not necessarily in the commodities, but you had periods of you probably studied those in college. The famous irrational exuberance, right, in the 90s when you had the dot-com, right? So
Mm-hmm.
and probably AI might be going through a similar kind of bubbly-like type of behavior. But when it comes to Hormuz, I can tell you, and I know the situation there well, I can tell you that the market may be a little bit too optimistic about the ability to normalize the flows in the straits in the next just in the next 2 to 3 weeks.
Okay. So, Claudio, I'm thinking, is market in any way sending signals to the political leadership by doing this kind of maneuver of being optimistic?
So, when it comes to this, I think that my position has always been not to look at the behind the scene, right? So I believe what I see, and I don't look for a second guess or some
Mm-hmm.
sort of below the table maneuver. What I think is right now the most of the market participants see a deal as inevitable. I said, look, the pain, the economic pain that the world economy would go through if Hormuz is not normalized will be almost unbearable to sustain. And the
Mm-hmm.
reason is that we're talking about probably $200 per barrel oil, which would bring about an enormous recession, an enormous recession. And so, with that in mind, you would think that all the parties involved, starting with the U.S. president, but also then with all the other stakeholders, be it China, be it, of course, Iran, and so on and so forth, they would work to find a solution and avoid a major recession, right? Avoid a
Mm-hmm.
major recession. That is what I think is at play right now. So it's the belief that the policymaker, and in this case also the commander in chief, would work towards finding a solution and prevent a mega recession from occurring.
Mm-hmm. Okay. Yeah, I see. So, based on what we are seeing now, does this resemble any past oil shocks like you were previously mentioning? Or are we entering into a structurally different kind of crisis now?
So this is what everybody's trying to find out, Amber. So I was in London 3 weeks ago, and everybody was asking me this question: is this a structural shift, or is this just a blip, right? So if you look at the history of, and again, let's just look at oil crisis for the sake of being of simplicity, albeit this is also an LNG crisis, right? Therefore, a natural gas crisis on top of being an oil crisis. But just looking at the oil crisis, you had two mega crises in the 70s. Then you had a very short one in the 90s, very deep but short. And then you have the Arab Spring in 2010, and you had the Russia-Ukraine war in 2022. You also had another crisis. I wouldn't call it necessarily a crisis. This was China's boom, economic boom, that brought about a very steady increase in oil prices from 2002 through 2008. That probably should be treated as its own thing, right? Because it's demand driven. But the other ones were supply driven.
Mhm.
So if you look at history, you would see that specifically for the crisis that had a long duration, for instance, the Arab Spring, it lasted for 3 years, right? So prices were high between 2010 and 2013. What happened? Well, you had a very important structural change, the birth of US shale.
Mm.
US shale production, which was transformative from a technological standpoint, was already there. What they needed was a catalyst, and the catalyst was high oil prices for a sustained period. Back in the 70s, you had these two mega crises. They last, as I said, for more than 10 years. Many things changed there. You had, for instance, the birth of deep water. You are in London. So this was the point in time when you start to develop in the North Sea and elsewhere in the world the more and more offshore and eventually deep water, specifically then here in the United States. You also had, back in the 70s, some very important adjustment on the demand side. This was the time when France decided to go all in for nuclear. So we started to get out of oil in the power sector. Italy, they started to import natural gas from Russia and substituting oil with natural gas. So you had all these structural changes. But then you look at one thing. You look at the crisis of the Gulf War in the 1990s. That was very short, very deep, but very short. What did that change? Nothing. Prices were low before, were low after. Oil demand kept on growing. Oil supply didn't do anything. So when what I argue is that it is still too early to understand whether this crisis is going to be structural or just a blip. For the time being, what we have seen are some marginal changes, right? So we have seen some uptick in electric vehicle in some countries, specifically those that are oil importing countries. Is this a structural change? We don't know, right? It could be, but definitely we don't know yet.
Right, right. Yeah, there are all these debates going on that this might be the change the world was looking for, moving into more climate friendly solutions and stuff like that.
So that is important because I know that this is the topic of your studies, and this is what probably your audience is going to be captured. The interest of yours is going to be about. I would argue that this is definitely an extremely important opportunity for renewable energy, right? And if you think about it, specifically in those countries that are fossil fuel importers, specifically oil and gas importer, and that's the majority of the world, right?
Yeah.
So if you think about it, you only have a handful of countries that are oil and gas exporters: the United States, Russia, Middle East, which is now under severe crisis, and Latin America. That's pretty much it, right? And in Latin America, we're talking about places like Brazil and Venezuela for the most part, right? So you have China, you have India, this big and growing economy. You have Europe, which is no longer growing, but still a big economy. These are all oil importing countries. So for them, renewables is not just a sustainable deal, right? Like 2 or 5 or even 10 years ago. It has become a matter of security. And energy security imperatives tend to be very powerful, right? So from this standpoint, coming out of this crisis, I wouldn't be surprised if places like institutions like the European Union would double down on adoption of renewable resources and so on and so forth. Same with India, same with China. So this is definitely a window of opportunity there.
Right. Claudio, I was just thinking that, like, if you see currently in the world, Russia, Middle East, Venezuela, they all are in a very tough situation.
Right.
There's a lot going on in geopolitics. Every day things are changing. So
Yes.
to make decisions, even short term, it's very difficult, right? Like, how do you judge these kind of scenarios?
So when it comes to the let's call it oil and gas production, specifically oil, the geology is hits randomly, right? So you have places like Venezuela that are gifted with huge resources, and places like France that have none, right? So that's unfair, you know. And guess what? France has the best above the ground risk in the world, amongst the best, and Venezuela, up until a few months ago, had one of the worst above the ground risks. So you always need to look at when it comes to extractive activities like the extraction of oil and gas, right? You always need to look at the below the ground risks, which are typically geologically driven, and the above the ground risks that are usually geopolitics driven, right? So you have this nice dichotomy of geology versus geopolitics, right? Now, up until February 28th, you would argue that the Middle East, specifically, the area of Kuwait, Saudi Arabia, to some extent Iraq, were blessed with wonderful geology. So the below the ground risks there were minimal, right? So the geology was fantastic. Break-even costs are extremely low and relatively stable and predictable above the ground risks, right?
Yeah.
Then the war erupts, and suddenly you realize that now the above the ground risks are enormous in this country for the most part, unless things quickly stabilize, almost unbearable, right? They are too high, right? So then you start to look at other parts of the world, right? So, and you do the same type of analysis of below and above the ground risks, right? So right now, everything outside of the Middle East, because of the sudden increase in the above the ground risk in the Middle East, becomes more palatable, in some cases even more attractive, right? Think of places like, well, for sure, North America as a whole gets a boost, but even places like Venezuela, which has recently has undergone a regime change. Now, all of this still remains very much in the future. You will always have these above the ground and below the ground risk. It's always been like this. So if you go back enough in time, you will see that the Middle East, even before this crisis, back in the 80s, the above the ground risks there were huge. In the 70s and 80s, huge. Then we went through a long period of peace, relative peace, at least in the Gulf region, and therefore people forgot that basically that there was a point in time in history where the above the ground risks were really high. The problem is that does not apply just to oil and gas. That applies to things like renewable, right? So if you think about it, the metals that go into the battery, or the metals that go into solar, and to some extent even the component of the wind, they are geologically configured. So you find metals in some parts of the world which may have great below the ground risk and awful above the ground risk. Think of all the African countries, right? So that are relatively unstable. And on top of that, you have places like China that currently dominate the supply chain for renewables, specifically batteries, which are increasingly getting at odds with the likes of the United States, right? So there is this thing called strategic rivalry, right? So the two countries are definitely not in a kind of what I call the Cold War, but they are inching into a situation in which they no longer see eye to eye and become more and more rivals. So you will always have these above the ground and below the ground risk, no matter what, right? So we happen to come from decades and decades of dependency on oil and gas, and therefore we always associate oil as intrinsically unstable. The reality is that no matter what you want to look at it, so if you start to depend on batteries, eventually you're going to find some weak points in those supply chains too, right? Which is in this case would be rare earths and energy metals, right?
True. Yeah, that's very true. Okay, so how resilient are major economies like China, United States, and Europe to absorb a prolonged shock at this stage?
Yeah. So let me start with Europe because that is the region in the world that is least resilient, right? So Europe started the year already on a not so great GDP growth, right? So we're talking about 1 to 1.5% growth in 2026, and it's fully dependent on oil and gas. Well, gas, there is some local production, but oil is almost entirely coming from abroad, apart from the production in the North Sea. So Europe, in case of prices in the 120, 130 for a sustained period, will most likely see a great reduction in GDP growth, most likely a recession, right?
Oh,
So unfortunately, Europe is very not very robust historically to high oil prices. You look at the history of, for instance, Germany economy. Every time you have an increase in the oil price, pretty much Germany goes into a recession. Now it bounced back really quickly, and it bounced back at high level, but they do have a recession in historically in Germany. So Europe is the least resilient. Then you have China. China came into 2026 with a GDP growth, I think in January was at around 5%, so quite strong. China hasn't seen a recession, recession defined as a negative growth for 2 quarters in probably decades. I don't know if they may have had a very short period during COVID that was, of course, driven by the lockdowns. But I don't think that China is exposed as much as Europe, albeit China imports 11 million barrels a day of crude every day. So even if they have huge inventories, so they build enormous strategic petroleum reserves, they eventually will run out. Okay, so China too, by I would say, if the situation in Hormuz is not solved by October, will have severe problem. And then we come to the United States, which is probably the least impacted. So it's the most robust to this oil crisis. And the reason is that the US is right now an oil exporter. It has been an oil exporter for quite a few years. And last week, it was the first time when it exported more crude than it imported. So not just an oil exporter, but also crude net oil exporter. So if you look at, thanks to the growth in the shale production, the United States right now, specifically the economies of Texas, Colorado, and the Dakotas, is very much resilient to a high oil prices. As a matter of fact, the economy in Texas before long it will be booming if this oil price spikes continues. Right now, the problem is what happens to other parts of the United States that are not oil producer, right? Oil and gas producer, for instance, New York, California. Of course, they will suffer, and these are also very big economy. So the U.S. Will not necessarily fall into a recession if we have high oil prices. It will be a big redistribution of resources from the coast down in places like Texas, Louisiana, and Colorado.
I see. Claudio, I just thought of a question like, so we had a government change from Biden to Trump,
Yes.
and Trump came with different policies. So
Right.
Biden has this Inflation Reduction Act.
Yep.
So I was thinking, is now the Trump policy is more pro drilling?
For sure. By by a huge margin, right? So the Inflation Reduction Act was a major policy back in 2022 that aimed at pretty much kickstart the whole renewable supply chain in the United States. In some cases, just to ramp up things like hydrogen, green hydrogen, things like offshore wind, solar, etc., and electric vehicle. What we saw with the new administration with Trump was a complete repeal of this, right? So it's not complete, a very significant repeal of many of the provisions, specifically those related to offshore wind and electric vehicles, some of the solar kind of legislation stayed in place, but it was still heavily reduced. And this there was a shift of emphasis when it comes to energy, what Trump calls the energy dominance, from renewable to back to fossil fuels, specifically oil and gas, under the famous slogan "Drill, baby, drill."
Yeah.
Right. So with this, all the electric vehicle subsidies were repealed, and that brought about a significant drop in EV, in EV sales, etc. So the United States is right now fully into the oil and gas energy dominance, no longer renewable, for sure.
Right.
But it's interesting because if you think about it, Amber, you have a major superpower like the United States, which is now fully re-embracing oil and gas. And then you have the rival superpower, which is China, and China is a renewable superpower. So right now you can actually play out this kind of risico, right? I don't know if you played this when growing up, but on the world map, it's not just the sphere of influences between the United States and China, but it's also kind of a struggle between fossil fuel and renewables energy
Right.
system. And so this is very, very interesting, extremely interesting time to be a scholar in this. Yeah.
Okay, so Claudio, final question looking ahead. What signals would indicate that this shock is deepening into a broader economic slowdown?
So I think that we need to look at things like inflation. That would be the first the first signal. So if we see inflation popping back up at 7-10% or even higher, then would be an ominous sign, because the next thing that happens is that the central bank will need to step in and increase the rates, and this usually brings about a reduction in economic activity and eventually a recession. So that would be the first signal. Yeah.
Perfect. So thank you, Claudio, for sharing such a clear and system-level perspective on today's unfolding energy shock. This conversation reminds us that the global energy systems remain deeply interconnected and vulnerable to geopolitical disruption. What happens in a single choke point can quickly translate into price volatility, economic risk, and implications for the energy transition. Understanding these dynamics is critical not only for policymakers and markets, but for everyone engaged in climate and energy leadership. To our listeners, thank you for joining the Climate Leadership Podcast. We will continue to explore the forces shaping our energy future. Until next time, take care and have a nice day. Bye-bye.
Thank you, Amber.
Thank you, Claudio.